Hello everyone, welcome to another video. And in this video we are basically going to continue with the chapter number 15. The name of the chapter is Everything Has a Price. Let's continue. Let's say if you want to buy a car, right? And usually you have a few options when it comes to buying a car, right? The first option you have is to buy a new car, and let's say that car will cost you around $30,000. The second option you have is to buy a used car, and of course that's not gonna cost you $30,000. It's gonna cost you a bit less, depending on how much it is used basically. And the third option you have, which is basically not the most common, is to avoid paying any price and to steal the car. So this is the third option you have. And keeping these three options in mind, we're going to look at how people think about paying the price when it comes to investing, right? And same as the example as buying a car, in investing you have three options. You can either pay the price when it comes to investing, and that price, as we have already discussed, is volatility, is the uncertainty, the fear, and the doubt. The second option you have is to pay a bit less of that price and go for like safer options. And those safer options, of course, give you lower returns because they are by definition not as risky. And the third option you have is to try to get the returns from your investments and avoid paying any price. And surprisingly, when it comes to investing, people usually think that they can take the option 3, which is basically to get the returns from the investment without paying any price. So many of these investors, what they actually try to do is to avoid paying the price. What they do is they try to basically sell their investments before the recession, and they try to get into the market before the next boom. In financing, there is something called tactical mutual funds, and what they are basically, they try to switch between stocks and funds in order to basically avoid the risks that come with the fluctuating market actually. So given at a given time, they would see, okay, what is the best choice according to the market fluctuations, and they would basically switch between funds and stocks to reduce the downsides, to basically reduce the downsides of the fluctuations, and also try to avoid the risk. So in order to see how they are really effective, the tactical mutual funds, the organization Morningstar actually looked into those, and they looked into these funds during the period of mid 2010 up till the late 2011 period. And this is a time when the US market was kind of like anticipating upcoming recession. And this is the time where the S&P 500 actually declined by 200 points, not by 200 points, but rather 20%. And this is exactly the kind of environment where you would expect these tactical mutual funds to perform, to do their magic, right? So what they found out was, out of 112 tactical mutual funds, only about 9 of them had better performance than compared to like a leave it alone fund, for example, where you're not changing the fund to basically adjust to the market fluctuations. So they eventually reported that, apart from a few exceptions, most of these tactical mutual funds, they were as affected as the other normal funds, and in some cases they even performed worse compared to the normal funds, and they were even more volatile than compared to the other funds. And the same thing actually applies to individual equity funds investors. So what happens is, or what happened was, that among all of their, like when they were doing all of their selling and buying, they were actually at least losing 0.5% per year. Um, so so the effect in the end was basically not very positive, and it could probably have been better, instead of them buying and selling, that they uh, if they would have just hold on to their stocks instead of just buying and selling. If they had just held on to it, then they would have been in a better position compared to where they were, by investing in the technical funds, and also like trying to adjust according to the market fluctuations. And the irony in all of this, and the irony in this whole situation, is that they usually end up paying more price. Um, uh, they they actually end up paying more price, um, compared to uh, compared to the price they would have paid, or rather we could say it like this, by avoiding to pay the price for the investments that they had made, and they eventually end up paying more price. Now we are going to return back to the story of General Electric. So General Electric um, basically made very consistent profits, um, and there was an element of predictability when it comes to their returns, their earnings, and that can be attributed to their CEO, which was their former CEO, Jack Welch. And he was very famous for ensuring that how much the company is gonna make in a quarter, or how much the value of the share is gonna be per quarter. So if the Wall Street, for example, said that the stock price would be $0.25, then Jack Welch actually made sure that the price was above 0.25, or let's just say 0.26. And so he was very good at that, and the way that he actually did that was that he would uh, basically twist the numbers a little bit. So what he would do is that he would uh, to adjust the current earnings from the current to adjust the earnings from the current quarter. What he would do, he would borrow the earnings from the next quarter, and from the next quarter, and then so he could adjust. So he could just adjust the numbers to his will. So while he was doing all of this, what was actually happening, that his shareholders, the GE's company's shareholders, they didn't have to pay the price of volatility, they didn't have to pay the price of doubt, and they were getting consistent, predictable returns. And then what actually happened, or what actually followed, was a decade of huge losses for the company and for the shareholders. And what ended up happening was that for that predictability and for that consistency, and as a result of that, they were basically making some pennies, right? For the pennies worth of, so basically for the pennies worth of predictability and certainty, they ended up paying dimes. They lost a lot of money. The company also lost a lot of money. And there is another example of another company, and a mortgage company called Freddie Mac and Fannie Mae. And what they were doing were, instead of over-reporting their returns, they were actually kind of like under-reporting. So So what would happen is that if in a particular quarter, if they had more money, they would report less. They would report less so that they could um, add those numbers to the coming quarters if those quarters had not performed as well as they have expected. So this was also kind of like giving their investors a sense of predictability, a sense of assurance. So why is that a lot of people are actually willing to pay, for example, for their houses, for their cars, even for vacations and all sorts of things that they need. But when it comes to paying the price for the financial investments, financial returns, people are not willing to do that. And the answer to this question is very obvious. And the answer is that the price for the financial returns is not immediately obvious. There is no price tag when it comes to financial returns. So what happens is that whenever the bill comes for the financial returns, it feels more like a fine rather than a fee. And as we all know that it's easier for people to pay a fee rather than paying a fine. So what we usually do is we try to avoid the fines. So the trick is basically to develop a kind of mindset that allows you to see the fee or the fine as something that's going to help you. It's going to help you to stick around long enough for your investments that you have made to give out returns in the long run. So basically, things start to look a little bit different when you see volatility as a fee rather than a fine. We're gonna look at an example of Disneyland. A Disneyland ticket costs like around $100, and that is basically a fee. And if you ask most of the people or the people who visited Disneyland, which would be in millions, and since all of them paid $100 for the entrance, and if you ask them if it was worthwhile, then most of them would say, or majority of them would say that it was actually worthwhile. The price of $100 was worthwhile to have experience with your kids, with your family, and those experiences that you will remember for the rest of your life, basically. And among those millions of people, there would be very few who would say that $100 ticket was not worthwhile. So that's the point here, that the same thing actually applies within investing. Where you have to see the volatility as a fee rather than a fine. One thing to note here would be that nobody is forced to pay for this fee. So as we saw in the case of Disneyland, for example, you can either pay the fee, $100, or you have another option to basically go to your local country fair, and there the fee might be like $10, or in the third scenario where you don't have to actually pay any fee, and then you can sit at home. And in all of these cases, you can probably have a good time. But the thing is, like, you usually get what you pay for, and the same thing happens with financial investing. With the good returns, you have to pay with the volatility. Again, the same thing, volatility and uncertainty. And it's actually better than going for like low fee parks, or basically sitting at home, basically. So yeah, so that is something to keep in mind. And one other thing that is very important, that there is no guarantee that whenever you buy a Disneyland ticket, whenever you pay for the fee, that you're always gonna have fun. There is a possibility that the day that you decide to visit Disneyland, it could be that it rains that day, right? But the thing is, like, if you never try, if you never pay the fee, then there is a possibility that you might never enjoy the magic. So this is it for this chapter. Hopefully you learned something. And this video was a bit choppy, I know, but I was trying something new. And I will see you in the next one. Ciao.